For most people, a financial shock is something loud. It is a headline, a crash, a sudden collapse that feels impossible to ignore. That image is comforting, because it suggests there will be a clear moment when danger arrives. A moment when everyone sees it. A moment when action becomes obvious. But global money systems do not work that way. The most disruptive financial shocks rarely begin with panic. They begin with quiet adjustments that feel reasonable at the time. Interest rates move slightly. Liquidity conditions tighten subtly. Capital flows change direction without announcement. Nothing breaks. Nothing looks dramatic. Everyday life continues. This is why most people believe shocks are sudden, when in reality they are slow. By the time the shock becomes visible, it has already passed through the most important layers of the system. The part that affects institutions. The part that affects governments. The part that affects markets. What remains is only the delayed impact on ordinary life. Higher prices. Lower purchasing power. Shrinking stability. And confusion about where it came from. The reason this happens is not because people are uninformed. It is because the system itself distributes consequences unevenly and over time. Money reacts early. People feel it late. This gap between reaction and experience is where most misunderstandings begin. It creates the illusion that crises arrive suddenly. It hides the fact that they were forming quietly for years. Right now, that process is already underway again. Not because of a single event. Not because of one policy decision. But because multiple pressures are converging in a system that no longer absorbs stress the way it once did. The next global money shock does not need a dramatic trigger. It only needs continued acceleration. And acceleration is already visible, if you know where to look. This video is not a prediction. It is an explanation. An explanation of how money systems actually behave under pressure. Why the most dangerous phase feels calm. And why waiting for obvious signs almost always means arriving too late. Why money shocks never start where people look. Most people are trained to look for crises in the wrong places. They watch stock market crashes. They wait for recessions to be officially declared. They listen for emergency announcements from central banks. These signals feel important because they are public, dramatic, and easy to recognize. But they are not where money shocks begin. They are where money shocks become visible. To understand why, it helps to think of the global financial system not as a single machine, but as layers of response moving at different speeds. At the surface level is everyday life. Wages. Prices. Employment. Consumer behavior. Below that is the policy layer. Central banks. Interest rates. Liquidity facilities. Regulatory adjustments. And below that is the capital layer. Large institutions. Sovereign funds. Corporate treasuries. Global investors repositioning trillions of dollars based on expectations, not outcomes. Money shocks originate in this deepest layer. They form when incentives shift faster than the system can adapt. When the cost of holding cash changes. When the return on safety erodes. When risk quietly migrates from visible places to hidden ones. These changes rarely announce themselves. They emerge gradually through technical adjustments that sound harmless in isolation. A quarter-point rate increase. A temporary liquidity measure. A balance sheet expansion framed as stabilization. Individually, these moves appear controlled. Collectively, they change the direction of money. And direction matters more than speed. Because once capital begins moving consistently in one direction, reversing it becomes increasingly difficult. This is why global money shocks are almost never caused by the events people blame. The 2008 crisis was not caused by a housing bubble alone. It was the result of years of credit expansion, mispriced risk, and incentive structures that rewarded leverage over stability. The pandemic shock was not caused by lockdowns alone. It exposed a system already dependent on constant liquidity support and fragile supply chains. In both cases, the visible trigger was late. The underlying stress was early. Today, the same pattern is repeating, but in a different form. Instead of excessive optimism, the pressure comes from sustained imbalance. Governments carrying unprecedented debt loads. Central banks attempting to normalize policy without destabilizing markets. Households facing rising costs without corresponding income growth. Each of these forces alone is manageable. Together, they create a system that relies on continuous adjustment just to maintain the appearance of stability. This is where people make a critical mistake. They assume stability means safety. In reality, stability in a high-pressure system often means fragility. When a system must constantly intervene to remain stable, it becomes less resilient to shocks, not more. This is not theoretical. It is a documented pattern in economic history. Highly managed systems tend to absorb small shocks while amplifying larger ones. The longer intervention continues, the more dependent the system becomes on those interventions. Eventually, adjustment itself becomes the source of instability. This is why money shocks often feel sudden. The system appears calm until it reaches a threshold. And thresholds are invisible until crossed. Another reason people miss the early stages of money shocks is because they expect pain to be evenly distributed. They believe that if a crisis were truly forming, everyone would feel it at the same time. That assumption is wrong. Money shocks move through hierarchies. They affect institutions before individuals. They affect asset prices before wages. They affect expectations before behavior. By the time everyday life feels meaningfully different, the system has already restructured itself. Capital has repositioned. Risks have been transferred. Costs have been passed downward. What people experience as a sudden loss of purchasing power or security is actually the final stage of a long process. This delayed effect creates confusion. People look backward in search for a single cause. They blame recent events. They argue about politics, policy, or personalities. But the real cause is structural. It lies in how modern money systems respond to pressure. In a slower world, caution worked. Saving money preserved value. Waiting reduced risk. Stability rewarded patience. In a faster system, delay becomes exposure. When prices adjust continuously, holding still means losing relative position. When policy shifts frequently, yesterday's safety becomes today's inefficiency. This does not mean reckless behavior is rewarded. It means that the definition of safety has changed. And most people are still operating under the old definition. This mismatch between belief and reality is where the next money shock draws its power. Not from surprise, but from inertia. People assume the system will behave tomorrow as it did yesterday. They assume corrections will be announced. They assume warnings will be clear. They assume adaptation can happen after the fact. But money does not wait for understanding. It moves according to incentives, not narratives. And right now, incentives are signaling adjustment long before public perception catches up. This is why focusing on headlines misses the point. By the time headlines appear, the most important decisions have already been made. The next chapters will explain how this movement happens, who responds first, and why the consequences feel disconnected from their causes. Not to create fear, but to replace confusion with clarity. Because clarity is the only thing that arrives early in systems like this. When people imagine money moving, they picture transactions. Someone buying a stock. A bank issuing a loan. A government announcing a policy change. Those are visible actions. They are not where movement begins. Capital moves first in expectations. Long before prices change, before jobs are lost, before households feel pressure, large pools of money begin adjusting to what they believe is coming next. This is one of the most misunderstood aspects of modern financial systems. Money does not wait for certainty. It responds to probability. Institutions do not ask whether something will happen. They ask whether the risk-reward balance is shifting. When that balance changes, even slightly, capital starts repositioning. Quietly. The reason this movement goes unnoticed is because it does not look dramatic. It does not resemble panic. It does not resemble collapse. It looks like optimization. Small portfolio adjustments. Changes in duration exposure. Shifts from one asset class to another. Individually, these moves appear routine. Collectively, they change the structure of the system. This is why capital often appears calm right before stress becomes visible. By the time people feel pressure in everyday life, money has already accepted that pressure is a cost and moved around it. To understand how this happens, it is important to understand who moves first. Large institutions do not manage money the way individuals do. They are not focused on absolute safety. They are focused on relative positioning. A pension fund does not ask whether inflation is rising. It asks whether its current portfolio will underperform if inflation continues rising. A bank does not ask whether interest rates are high. It asks whether its balance sheet is vulnerable if rates move higher or lower than expected. A government does not ask whether debt levels are uncomfortable. It asks whether the system can continue functioning under those debt levels. These questions lead to early action. And early action compounds. Once a few large players begin adjusting, others are forced to respond. Not because they agree, but because staying still becomes a risk. This is one of the most important dynamics in modern finance. Risk is not only something you take. It is something you inherit by not moving when others do. This is how capital flows accelerate. Not through fear, but through alignment. As more institutions reposition, liquidity concentrates in certain areas and drains from others. Some markets become crowded. Others become fragile. This fragility is rarely obvious at first. Prices may remain stable. Volatility may stay low. But beneath that surface, the system becomes increasingly sensitive to disturbance. This sensitivity is what turns small shocks into large consequences later. Another reason capital moves early is because modern systems are deeply interconnected. Changes in one area propagate quickly through others. Interest rate adjustments affect currency values. Currency movements affect trade balances. Trade imbalances affect corporate earnings. Corporate earnings affect employment and wages. These connections mean that stress does not need to be large to matter. It only needs to be persistent. Persistent pressure forces adaptation. Adaptation forces movement. This movement often appears contradictory to observers. Markets can rise while living costs increase. Asset prices can stabilize while purchasing power declines. This confuses people because they assume all parts of the system move together. They do not. Markets reflect capital expectations. Everyday life reflects delayed outcomes. This time gap is not accidental. It exists because capital is designed to move faster than human systems. Regulation reacts slowly. Wages adjust slowly. Social structures adapt slowly. Money does not. In earlier decades, this gap was smaller. Economic systems were simpler. Financial instruments were fewer. Global integration was limited. Today, capital operates at a scale and speed that outpaces public understanding. This does not make the system evil. It makes it asymmetric. Those closest to capital experience early signals. Those farthest experience late consequences. This is why many people feel blindsided by financial stress. They assume it appeared suddenly. In reality, it was absorbed and redirected long before it reached them. One of the most important mechanisms in this process is liquidity. Liquidity is often described as how easily assets can be bought or sold. But at a deeper level, liquidity represents confidence. When liquidity is abundant, participants believe exits will be available. When liquidity tightens, participants begin protecting themselves. This protection does not always mean selling. Sometimes it means shortening time horizons. Sometimes it means holding different forms of value. Sometimes it means reducing exposure quietly. These shifts are subtle. They do not generate headlines. But they alter the system's ability to absorb shocks. As liquidity becomes more selective, small disruptions travel further. What would have been a contained issue in a liquid environment becomes amplified in a tight one. This is how money shocks gain momentum without spectacle. Another misunderstood factor is policy signaling. Central banks and governments communicate intentions constantly. Markets listen closely, not to the words, but to the implications. A promise to fight inflation signals tighter conditions. A promise to support growth signals accommodation. A promise to balance both creates uncertainty. Uncertainty is not neutral. It forces risk recalculation. When policy objectives conflict, capital chooses its own interpretation. And that interpretation shapes flows. This is why official reassurance often fails to calm systems under stress. Markets are not reassured by confidence. They are reassured by coherence. When coherence is missing, capital begins hedging against multiple outcomes. Hedging is movement. Movement reshapes the system. This reshaping continues quietly until something breaks. Not necessarily a collapse. Sometimes it is a slow erosion. Higher prices without higher wages. Lower returns without visible losses. Reduced opportunity without obvious restriction. This erosion feels personal to individuals. But it is systemic in origin. It reflects the cumulative effect of early capital movement responding to long-term pressure. The reason people struggle to see this coming is because it does not violate expectations immediately. Life continues. Jobs remain. Consumption persists. But the margin for error shrinks. Resilience declines. The system becomes less forgiving. And when forgiveness disappears, adjustment becomes unavoidable. This is the stage the global system is approaching again. Not through panic. Not through collapse. But through continuous repositioning that leaves less room for stability. The next chapter will explain why this stress takes so long to reach everyday life, and why the delay itself is what makes the shock feel sudden when it finally arrives. One of the most confusing aspects of global money shocks is not the shock itself. It is the delay. The long, uncomfortable gap between when stress enters the system and when people actually feel its consequences. This delay is not accidental. It is built into how modern economies function. Understanding this delay explains why people are repeatedly caught off guard, even when warning signs were visible for years. At the system level, stress is absorbed, redirected, and postponed. At the human level, stress arrives suddenly and feels personal. This disconnect is where most frustration comes from. When people ask why life became more expensive, more unstable, or more uncertain so quickly, they are really asking why the system seemed fine until it wasn't. The answer lies in how costs travel. Costs rarely move directly from cause to consequence. They move through layers. The first layer is financial. When pressure builds, institutions adjust balance sheets. They change lending standards. They alter risk models. They shift capital allocation. These adjustments are internal. They do not immediately affect consumers. The second layer is corporate. Companies respond to higher financing costs, supply pressures, or margin compression. But they do not react instantly. They delay decisions. They absorb costs temporarily. They renegotiate contracts. They reduce future investment instead of current operations. This creates the illusion of stability. Employment remains steady. Prices rise slowly. Nothing appears broken. But internally, buffers are being depleted. The third layer is labor. Only after financial and corporate buffers are exhausted do costs begin transferring to households. Wages lag. Job security weakens. Purchasing power erodes. This is when people finally feel the shock. But by this point, the underlying stress has already reshaped the system. The delay creates a psychological trap. People assume that if conditions feel stable today, the system must be healthy. They mistake lag for resilience. In reality, lag often signals strain. This is similar to how physical systems behave under pressure. A bridge does not collapse the moment stress appears. It absorbs load until structural limits are reached. The collapse feels sudden only because the buildup was invisible. Economic systems operate the same way. The longer stress is absorbed, the more dramatic the eventual adjustment feels. Another reason for the delay is policy intervention. Modern governments and central banks actively work to smooth outcomes. They inject liquidity. They adjust rates. They provide guarantees. These actions are not inherently bad. They are designed to prevent panic. But they also extend the adjustment timeline. By cushioning immediate impact, policy shifts consequences forward in time. This reduces short-term pain at the cost of longer-term distortion. People experience stability now and instability later. This trade-off is rarely discussed openly. It is politically uncomfortable. But it is structurally important. When policy delays adjustment, it does not remove cost. It redistributes it, often downward. Those with assets benefit from stabilization. Those dependent on income feel erosion later. This redistribution is not a conspiracy. It is an outcome of how systems prioritize continuity. Another factor that deepens the delay is expectations. People do not change behavior until pressure becomes undeniable. They continue spending. They maintain lifestyles. They rely on past assumptions. This behavioral inertia supports short-term stability. But it also increases vulnerability. When adjustment finally arrives, it arrives into a system that has not prepared for it. This is why downturns feel harsher than expected. Not because the cause was sudden, but because adaptation was postponed. The delay also explains why public debate often focuses on the wrong moment. People argue about when prices started rising, when rates increased, or when a crisis was declared. But these moments are late in the process. The true turning points occurred earlier, when incentives changed. When borrowing became more expensive relative to growth. When returns failed to keep pace with costs. When risk was mispriced quietly. These moments do not produce headlines. They produce adjustments. And adjustments compound. By the time everyday pain appears, the system has already committed to a new path. Reversing that path becomes difficult. This is why attempts to fix the situation often feel ineffective. People demand relief after the system has already moved on. Policy responses lag behind lived experience, just as experience lagged behind system stress. The result is frustration on all sides. Individuals feel ignored. Institutions feel constrained. Governments feel trapped. This tension is a defining feature of money shocks. It is not a failure of awareness. It is a consequence of timing. The most dangerous phase is the middle. The phase where stress is real, but pain is muted. This is when complacency is highest. This is when warnings are dismissed. This is when adaptation would be easiest, but least likely. Because nothing feels urgent yet. Historically, this phase lasts longer in more complex systems. The more interconnected the economy, the more buffers exist, and the longer consequences can be delayed. But complexity also increases fragility. When adjustment finally occurs, it propagates through many channels at once. Housing, employment, consumption, confidence. What feels like multiple problems is often one delayed adjustment unfolding across layers. Understanding this delay reframes how we interpret economic calm. Calm does not mean absence of pressure. It often means pressure is being managed. And managed pressure does not disappear. It accumulates. The next chapter will explain why the current cycle feels different from previous ones, and why the margin for absorbing delay is shrinking. Every generation believes the next crisis will resemble the last one. This belief is comforting because it suggests familiarity. It implies that past experience can be reused. It creates the illusion that preparation is simply repetition. But money shocks rarely repeat themselves in the same form. They evolve. And the most dangerous shocks are not the ones that look dramatic. They are the ones that quietly invalidate old reference points. This is why the current cycle feels confusing to so many people. It does not match the mental model built from previous crises. In the past, shocks were easier to localize. A housing crash. A banking failure. A sovereign debt problem. There was a clear source of stress. Today, stress is distributed. It is spread across governments, corporations, households, and financial markets simultaneously. No single sector is collapsing. No single policy error can be blamed. Instead, the system is strained everywhere, just not enough in one place to trigger immediate collapse. This makes the shock harder to recognize. One of the biggest differences in this cycle is the role of debt. Debt has always existed in modern economies. But its scale and function have changed. Previously, debt expanded during growth periods and contracted during crises. Now, debt expansion has become the mechanism used to avoid contraction. When growth slows, borrowing increases. When stress appears, liquidity is injected. When instability threatens, balance sheets expand. This creates a system that depends on constant intervention to maintain equilibrium. At first, this approach appears successful. Crises are avoided. Markets stabilize. Confidence returns. But over time, dependency builds. The system becomes less capable of absorbing shocks without additional support. Each intervention raises the baseline level of stress. Each stabilization reduces future flexibility. This is why the current environment feels stretched. There is less room for error. Another difference is inflation dynamics. In previous cycles, inflation was often associated with overheating growth. Today, inflation is tied to structural constraints. Supply chain fragility. Energy transitions. Demographic shifts. Geopolitical fragmentation. These forces do not resolve quickly. They persist regardless of policy intent. This changes how inflation behaves. Instead of spiking briefly and subsiding, it becomes uneven and persistent. This persistence complicates policy responses. Tightening too aggressively risks destabilizing debt-heavy systems. Loosening too quickly risks reinforcing price pressure. This tension did not exist at the same scale in earlier cycles. As a result, decision-making becomes slower and more cautious. But caution at the policy level can increase uncertainty at the system level. Uncertainty accelerates capital movement. Capital dislikes ambiguity more than risk. This dynamic amplifies stress. Another key difference is the erosion of buffers. In the past, households often entered crises with some margin. Savings rates were higher. Housing affordability was better. Debt burdens were lower relative to income. Today, many households operate close to their limits. Small changes in prices or interest rates have outsized effects. This reduces the system's ability to absorb delayed consequences. When stress finally reaches everyday life, it does not dissipate gradually. It compounds. This contributes to the feeling that conditions deteriorate rapidly. Not because the shock is sudden, but because resilience has declined. The labor market also behaves differently in this cycle. Employment may remain strong longer, but adjustments can be sharper when they arrive. Companies delay decisions as long as possible, then act decisively when margins no longer support delay. This creates periods of apparent stability followed by rapid adjustment. People interpret this as unpredictability. In reality, it reflects accumulated pressure being released. Technology adds another layer. Information spreads faster than ever. Expectations adjust quickly. Narratives shift rapidly. confidence can erode in days instead of months. This speed affects behavior. People react not only to conditions, but to perceptions of conditions. This feedback loop amplifies stress. It did not exist to the same extent in earlier eras. All of these factors combine to make the current money shock feel different. There is no single breaking point. There is no obvious villain. There is only gradual compression. The system continues functioning, but with increasing friction. Costs rise unevenly. Opportunities narrow selectively. Stability becomes conditional. This environment rewards adaptability and punishes delay, even when delay feels prudent. This is why many people feel that being careful no longer works. Not because caution is inherently flawed, but because the context in which it was effective has changed. The old rules assumed a system that rewarded patience. The current system rewards positioning. This does not mean reckless behavior is safe. It means static behavior is exposed. Understanding this distinction is critical. Without it, people interpret the shock as personal failure or random misfortune. With it, they see it as systemic transition. The purpose of this video is not to create fear. It is to replace outdated expectations with accurate ones. Because the greatest risk during a money shock is not volatility. It is misinterpretation. The shock that feels different is often the one that is least understood. And misunderstanding is always expensive. What most people experience as a sudden crisis is rarely sudden. It is the final stage of a process that unfolded quietly over time. Money moved first. Incentives shifted. Pressure accumulated. By the time everyday life began to feel different, the system had already adapted. This is why money shocks feel confusing. They do not announce themselves clearly. They do not arrive evenly. They do not follow the timelines people expect. Understanding this does not prevent change. But it changes how you interpret it. Instead of reacting to headlines, you begin noticing patterns. Instead of waiting for confirmation, you recognize movement. Instead of assuming stability means safety, you understand what stability actually costs. This channel is not about predicting the future. It is about explaining how systems behave when pressure builds. Because money does not move randomly. And shocks do not come out of nowhere. If this explanation helped you see the structure beneath the headlines, then you already understand why awareness matters early. For calm, clear explanations of how money, power, and incentives really work, subscribe to Rich Simplified. New videos break down complex systems without noise, hype, or panic. Just clarity.